62. That is how many of today's 78 5-minute bars closed above where this index finished on Friday. 79% of the session spent in the green, and the closing print was 14.41 points lower. AlgoIndex market close, Monday, July 20th. Everything that went wrong today went wrong after 2:40 in the afternoon. The rest of the session was fine, and the rest of the session did not matter. Three numbers carry tonight. 7,000 lots, minus 0.5919, 220 points. Not one of those appeared on your chart today, and each one owns a different piece of that last hour. Close, 7,443.28. Down 14.41, a fifth of 1%. High of 7,512.76, 10 minutes after the bell. Low of 7,440.53 at 3:20 in the afternoon. 72 points of range, 97 basis points. The fear gauge finished at 18.66, 0.5% lower on a day the index fell. Its own volatility index came down nearly 2%. Put and call volume ran 1.29 to 1, easier than Friday's 1.54. Read that block cold, and you would not guess the index lost ground. That mismatch is the whole episode. Semiconductors rallied at the open and faded into the close. So did everything else. One shape, repeated at every level of the market. Then the flow, which is where it stops being a story and starts being arithmetic. Index hedging flow finished at minus $3 billion of delta notional. Single stock flow also finished at minus $3 billion. Same sign, same size, and two completely opposite mechanisms underneath. The index figure came mostly from longer-dated call selling. The single stock figure came from longer-dated put buying, concentrated in the largest technology names. One set of desks gave up upside. Another set paid for downside. Both print negative. Read only the headline, and you would file them as the same trade. And here is the piece that set the terms for all of it. The published net gamma series closed Thursday at minus 0.0532. It closed Friday, after monthly expiration, at minus 0.5919, 11 times more negative in a single session. Today was the first day this market traded underneath that arrangement. 1 month implied correlation printed 6.8, so index volatility and single stock volatility stayed apart, which is the condition that has defined this entire month. Two prices mattered today, and both were published before the opening bell. 7,510 is the volatility inflection level. 3 5-minute bars printed above it all day, and all three landed inside the opening 25 minutes. The last of them ended at 9:50 in the morning. Across the 370 minutes that followed, this index never touched 7,510 again. 7,470 is the dealer gamma flip level. Price closed above it on 49 bars, below it on 29, and crossed it 7 separate times. The final close above it landed at 2:30 in the afternoon. After that, there was only one direction left. The low at 7,440.53 stopped 0.6 of a point beneath the halfback of the 4-week range at 7,441.14. Ask yourself how often your own screen puts that line up before price arrives at it. There is also a reason the boundaries held as neatly as they did. Roughly 7,000 lots of a same-day expiry iron condor sat with short strikes at 7,545 to 50 overhead and 7,425 to 30 beneath. The session high stopped 32 points below the upper wing. The session low held 10.5 points above the lower one. Neither side was ever seriously tested. Somebody sold the exact range this market went on to trade. For scale, the market's own implied range ran 7,552.35 on top to 7,433.95 underneath. The high fell 39.5 points short of the upper figure. The low came within 6.5 points of the lower one. 61% of that envelope got used, and all of it on the downside. Apple puts struck at 335, expiring the same day they were bought. 14,848 contracts bought to open, against 15 sold to open. So there is nothing ambiguous about which side of it anyone was on. What earns this one the segment is not the size, it is the timestamp. That position was named in the morning flow report, before the move, with the stock still at 333. Apple then fell 2% to close at 327. And those puts traveled from roughly $3 to roughly $10 in 2 hours. A 233% return on a contract with hours left to live. The same name recorded its most negative daily hedging flow of the past 30 days at minus $788 million on 1.9 million contracts and $4.2 billion of gamma notional. Implied volatility closed at 15.45. Realized closed at 15.05. Implied now sits 0.4 of a point above realized. And on Friday, it sat 0.16 below. That crossover happened on a session where the fear gauge went down, which is not the usual pairing. Implied volatility rank is 30.55. The percentile 72. And the bid was not spread evenly across the curve. Implied volatility for this week's expiration rose by 1.5 to 4 points. Everything past this week was largely unchanged. Traders paid up for the next 4 sessions specifically, and the next 4 sessions are the ones holding the earnings. One thing tonight's data does not settle. The Flow Report's own summary calls the largest fund position an extreme $1.74 billion delta, reflecting bearish sentiment. Its positioning section calls that same position an extreme $2.9 billion positive delta. The sign and the size disagree inside one document, so we are not going to hand you whichever version makes the cleaner sentence. 2 wins, no losses, 1 break-even, 3 that never filled. The automated strategy went short at 7,522.75 on the futures at 10:01 and came out 10 minutes later for 7 points. A second short went on at 7,519.25 and closed at 7,511.75 for 7.5. The third position is the one that deserved the airtime. Long from 7,505.25, target 7,518.5, closed at roughly break-even after 91 seconds. The target printed afterwards, 13.25 points, read correctly and not collected. We are not filing that as a scratch because it was not one. All 3 of the no-fills had the direction right. On a session this one-directional, having the direction right and the entry price wrong pays precisely nothing. And that is the honest reading of this record. We stood down publicly at 11:24 and did not trade again. The afternoon never produced a setup that cleared the bar, so the stand down held. Begin with what moved while nobody was watching it move. The primary put support, the strike where downside protection concentrates, sat at 7,520 on Wednesday and again on Thursday. After Friday's expiration, it prints at 7,300, 220 points lower, confirmed by 2 independent fields inside the same published series. Which means tonight's close carries 143 points of open air beneath it before the next structural support shelf. Last Wednesday, that cushion sat about 20 points away. Nothing sold off to cause that. Now the pull, and it points both ways. Maximum pain for tomorrow computes to 7,490. From 2 separate calculations that agree, and it sits 46.72 points above tonight's close. The strongest magnet strike anywhere near this market carries a 98.1 reading and sits at 7,428, 15 points below the close. So the pin is overhead, the magnet is underneath, and the close is beneath both the gamma flip level at 7,470 and the decision line at 7,480. Anyone selling you a tidy direction out of that arrangement is filling airtime. What actually resolves it? Reclaim 7,470 and hedging returns to cushioning, which reopens 7,490. Lose 7,440.53 and nothing structural stands until the pivot support at 7,418. The calendar is quiet tomorrow. Wednesday after the close is the week. Alphabet and Tesla, alongside Texas Instruments, ServiceNow, and IBM. That arrives at a market whose downside cushion just moved 220 points further away. On Friday, we told you Monday's map would be rebuilt from scratch. It was. You are looking at the rebuild. The journal is free. Give it a trade, and it marks that entry against the lines that were actually on the board at the time. Sign up at members.algoindex.com/auth/signup. Every level in tonight's episode gets scored in public, whether the score flatters us or not. That record sits at algoindex.com/tools/gamma-level-accuracy. Longer written work goes up at algoindex.com/blog. The trading community runs on Discord by invitation. 62 bars in the green and a red close. Tomorrow, this market starts its arithmetic from underneath both lines.